Okay, some of you have seen this already, some of you have seen it but in the presentations, but you have not seen it to the detail that I'm going to give it now. So be patient with me. Take notes. This drawing is the entire business in a nutshell. So if you were texting on your phone, you got the TV in the background, if you pay attention to anything, pay attention to this section. 5 p.m. the high and low reset, market makers make the quick push, right? 15 to 25 pips up, 15 to 25 pips down, and consolidate. This initial move sets the initial HOD, the initial high of the day. All times are 5 p.m. New York time. All times are Eastern Standard New York, okay? NYC time. Sorry about that, okay? This move also sets the initial low of the day. You Craig Harris guys call this the Tokyo channel. It's simply the market maker spread. Okay? They trade in between this range, accumulating contracts. Anytime you see sideways movement in the market, it's not congestion. I've heard it called so many different things, it's funny. You don't have a chest cold when you're trading. It's not congestion. It's not a traffic jam. Anytime market makers hold a level and move sideways, they are hitting the stops, inducing traders to take a position, and collecting contracts for their pocket. That is it. There is no other explanation for it other than what it is. Okay, now, between 5 and 8 p.m., New York closes at 5 o'clock. There is a thing I've heard it called Dharma. It's the dead time in the market. There is nothing going on. A lot of traders use this time to scalp the market with robots because it just kind of chops sideways. Let me illustrate this, then we'll talk about questions. From 5 to 8, there's absolutely nothing going on in the market. All exchanges are closed. From 8 to 8:30 p.m., there's a thing called gap time. All times are Eastern New York. Gap time is when the market maker comes on duty and he gets his instructions for the day from the powers that be of what he's supposed to do. Man, I wrote 8 p.m. twice. It's 8:30, sorry. 8:30 p.m. 8:30. All right. The market opens, the Asian session opens at 8:30. Okay, what takes place in gap time? Hey, what's going on today? I got long holders trapped high on the aggregate at 129.27. I need you to hit the stops, pick up some pending orders over there, and I want price down at 125.35 by the end of the day, by the end of your session. Will do, got it. Hey, I got $600 million in open float. We're a little out of shape with our equity. I need you to hit the stops and even some of that out. I need you to get it down to about $400 million in open float because we can handle that. Our equity pool's getting out of whack. It's not 8 p.m. in Tokyo. It's the morning over there. I don't really know how the times convert over there. It's 8 p.m. New York City to 8:30. Market maker gets his instructions. He goes to work. Now, he also is told that he has to continue to accumulate. Collect the contracts, balance out the books, whatever it is. Most of the time, the accumulation phase goes through the Asian session. In a perfect world, the accumulation happens all through Asia, breaks out London, starts the move, continues, reverses US, and goes back into consolidation. But if it was that simple, there's a lot of smart people out here. Craig almost figured it out. people would figure it out. So with that being said, they change the session times when the moves occur to keep people confused and unable to figure it out. That's all it is. By switching times, they throw people off. Nuclear reactor blew up. Let's move the end pairs today during the Asian session. Duh. Nothing going on. Let's hold it and let's not move it till the U.S. Okay? They will hold the swing through the session till about 1 to 2 a.m. Okay? Now here's what happens. At the start of the London session, the first move is to pick up the pendings and destroy the breakout traders. Some of you guys have heard of the Frankfurt Power Hour. There's no such thing. It's bullshit. What they do is they widen the swing early, Frankfurt time, and pick up the pending orders, validate any fib patterns, and they take those guys out. In an ideal world, between 3 and 4 a.m., 3:30 being ideal, between 3 and 4 a.m., they make an aggressive move, in this example, towards the high and extend the initial high of the day. That move is comprised of 3 individual pushes. 1, 2, 3. Remember I told you about the number 3 in the presentation? 3 is a psychological barrier for human behavior. You've been saying it all your life. Things come in 3. 3 strikes, you're out. If someone dies, they go, oh, one more. Right, it comes in 3s. You've heard that crap all your life. We're programmed as people psychologically to procrastinate and to hesitate. The 3 pushes ensures the market maker that you will in fact chase that trade. The 3 makes you do things based on your human psychology, fear and greed and things that drive the market, ensures that you will take the wrong position. It's dirty, but that's why they do it, because it works. Here's what happens. You're standing there, and you see the thing push right out. It pulls back. You go, maybe it's going long today. They hit it again. Bam. They extend the high again. You go, damn, look at Euro. It's going up today. I'm missing it. They hit it a 3rd time. The 3rd time makes you realize that you're missing the trade and you want to get on, and you buy at the worst possible point in this scenario. You place your orders in here. Okay? This action goes on around 2:30, 2:45, 3 o'clock. When they get those orders hot, validated, and piled on, they quickly pull off 20 to 25 pips. And I'll go over this again. But just, this is a very important part of the business. Pay attention. They'll pull back quickly. They repeat the level but fail to break it. They fail to take out the high of the day. They might throw a wick above it. That's acceptable. The wick grabs the orders. They will then pull away and go into consolidation. They shift the zone away from all this work in here. The London session starts at 3:30. p.m. Eastern Time, New York. The Asian session ends at 3 a.m. Steve, that doesn't line up. The gap time from 3 to 3:30 is when the Asian market maker discusses his moves with the London guy that's coming on duty now. The London guy receives his marching orders from what Asia was able to accomplish or not accomplish and what needs to happen to keep the bank liquid and making money. When they pull away and go into consolidation, the traders are jammed up that are traded long above here. Higher level long holders are jammed. They will then make 3 levels of drop. Okay? Ask me to repeat the 3 a.m. time, no problem. The changeover, the Asian session ends at 3 a.m. The London session begins at 3:30 a.m. New York time, Eastern Daylight Time, whatever the hell we're on right now. Okay? The gap time is from 3 to 3:30. From 3 to 3:30, you might see a stop trigger. You might see them put in the second leg. Or start making the second leg. There's a trade that we call the Brinks trade, and I'll illustrate the rules for you, but I want you to understand. The Brinks trade is when the second leg of the M or W is formed on the 345 candle. Okay, write it down. The Brinks trade is when the second leg, M or W, could be a V bottom too, but for now let's just go M or W, is formed on the 345 candle. What the hell are you talking about, Steve? False move, end of session. Price rises as we go into the end of the session in Asia. It makes a false move, session beginning, issues a spike to the high, and will close on a hammer at 345. False move, session beginning. The reason that we call this a Brinks trade is because we're so certain it will pay out you can back up the Brinks truck on it. There are 2 Brinks trades a day. I will illustrate them for you here. All pairs, any pair. If you get second leg M or W issues a hammer at 345, lights out. Back up the Brinks truck. You will get paid. The 3 levels of drop will form during the night of about 6 to 8 hours. Look, I don't know your time zone converted on timezones.com, man. I don't know. New York time, if you're in California, -3. If you're in Hawaii, -5. Figure it out. Paul, nice to see you. Write it down, buddy, and figure it out over there in Texas. I don't know what the hell's going on over there. All right. Need to come over there and eat some ribs with you, buddy. I miss you. Hope you're doing all right. Okay. When you get 3 levels of drop, most of the time, because you have an extended move, you will get the W formation on the opposite end of the chart, and you will get the retracement back into the range. I mean the 345 candle that paints from 330 to 345 and locks. Okay? So now, the Brinks trade comes in, second leg M or W, when the candle paints from 330 to 345 and is a hammer spike. I'm going to talk about the rules and more stuff. We'll go over it. Just want you to see it right now. Now, let's talk about ADR. If you have an ADR on a pair, which is average daily range, average daily movement, sorry about my drawing. Okay, now, a pair moves 100 pips, right? I just told you there's 3 levels of drop or rise. In this example, there's 3 levels of drop. What's 100 divided by 3 levels? To make it easy, let's say 33. I know it's 33.333, whatever. It's 33. Each level will contain approximately 33 pips. Right? Understand? Each level contains about 33 pips. So you have a burst or move of 33 pips in each level before a retracement or consolidation is seen. They'll hold it a little bit. Mid-session, they'll consolidate. They'll burst 33 pips again. Consolidate around the 8 o'clock hour a.m. Then they will burst again 33 pips to finish out the session. Understand? So if a pair is 150 ADR, like the pound, or 200, take 150 divided by 3, you're going to get 50 pip bursts of price movement. To give you the 3 levels. This is universal in every single pair, in every platform, with every dealer. And I always trade on the 15-minute chart. Just don't worry about charts right now. Just get this illustration down. Pay attention to this. This is the whole business right here. Don't worry about it, Mac. We'll get to it, buddy. Hang in there. Nice to see you. Okay. If a pair has an ADR of 150 pips, then you will get 50 pip price bursts. Then they will do the same thing. They will go into consolidation. They will trap short, hit the stop, show one more push down, pull back. Second leg will form. At 9:30, I'm sorry, at 9 o'clock, over here, this drawing's getting out of control. I should have did smaller writing. At 9 a.m. New York, the London session comes to a close. The New York market maker comes to work, and he talks to the London guy. Gap time, 9 to 9:30. At 9:30, the U.S. equities market opens. The FOREX is lined up with the U.S. equities open to create the moves based on news releases and whatever else is going on in the equities market. If you are issued second leg W, in this example, a hammer spike to the bottom at 9:45 candle close, 15-minute chart, Coke, I'll cover the ADR. Relax. If a 9:45 a hammer is issued, Brinks trade number 2. The reversal is imminent. If the second leg M or W forms the HOD or LOD at 3:45 or 9:45, that trade will pay out today. That's it. That's the Brinks trade. Those times are lined up. False move, session beginning, equities open. 9:30, the equities market opens, a hammer to the low. 15 minutes into the session, they pull it back and close and paint a hammer. They spike to the low and close the other way. They trap the traders, pick up the orders. Make the reversal back into the range. Consolidate, okay? Consolidation comes in around 12 or 1 o'clock in the afternoon. This happens in all pairs on a regular basis when you're hunting for the M and W. We have shadow boxes on the charts. We'll talk about it. Okay. Boy, I made a mess, didn't I? Let's see if I can get another clean one here. One, two, three to the high. You're going to get 3 bursts or pushes to the high. It can be in 3 candles, which is a work of art. It can be in one big, huge candle. But when you watch that candle, you will see 3 pumps to the high or 3 pumps to the low. The 3 pumps is based on trader psychology. The 3 levels is also based on trader psychology, because you come to it and you see a beautiful downtrend. All the technicals are validated. They turned over. They're showing a drop. You go, man, I miss Euro's fall today. Let me take some of that. Bam. They pull it away from you and say, just kidding. Okay, here's the Brinks trade for the second leg. Here is second leg. If this leg issues a hammer, a spike, or if this leg is comprised from 9:15 to 9:45 of railroad tracks. Sneaky. Here. If this leg is in 2 moves, green going up, red coming down, and this will be from 3:15 to 3:45. It's a half-hour move. If that comes in at the session changeover, think about the second or third slide in. False move, trap move, end of the session, beginning of the next session. They jam you up at the changeover. 9:30, the same thing applies down here. 9:15 to 9:30, they issue railroad tracks. That goes on to 9:45 rather. Okay? If they issue 1 bar at 9:45 and it comes in as a spike to the low or a hammer, and this forms the LOD, the low of the day, or this behavior forms the high of the day, that is a Brinks trade. We're going to go over it again, don't worry. Just want you to see it and get the concept. The 3 levels that are in the chart prey upon you to chase the wrong directional move. They put the brakes on at the bottom. When you sell into the worst possible point, they put the brakes on, jam everybody up right in here. Okay? The times again, you ready? 5 p.m., high-low reset. I'm not going to write them all. I won't spell them all the way out. High-low reset. 5 to 8, it's dead gap, nothing going on. 5 to 8 p.m., dead gap. 8 to 8:30, Asian gap. Okay? I have a slide for this stuff, so if you're not getting it now, don't worry. 8 to 8:30, dead gap. Asian gap. Session starts 8:31, runs to 3 o'clock. 3 to 3:30, London Asia gap time. Instructions are passed. 3:30, session starts. Brinks trade comes in from 3:30 to 3:45. The move to start the session and trigger the orders the wrong way. 3 levels of drop or rise will be seen. The opposite behavior of the M or W is performed between 8 and 10, 8 and 11. The ideal time being 9, end of the London session, 9 to 9:30 gap, 9:30 U.S. session in line with the equities open. 9:45, if a Brinks trade is issued, you'll get a hammer or spike to the low. These times are all right now daylight savings in line with what we're doing. In the winter, when we move the clock, in the U.S., the moves will be seen around 2. But the equities open does not change because it's still 9:30 here in New York, no matter what the clock is on, standard or daylight savings. Okay. So what happens is, in the winter, the London session is an hour longer. It's irrelevant. 9:30 in line with the equities open. Ron, I don't know what you read or thought. Don't worry about it. It's BS. Here's the deal. All the times that you've read, all the stuff that you've been told at the retail level, all the crap, the clock on there from Yahoo and Auckland and New Zealand comes online, and your mother wakes up and throws a couple trades on, and Japan wakes up, and then New Zealand starts trading. It's all bullshit. Those times are garbage. They are not going to give you the timings. They are not going to say, we're going to jam you up at 331. They're not going to say that. You're not going to find that information out. Again, I need you to subscribe to something different. Don't rely on the stuff you've read. It's crap. Okay? These are the times. Take them to the grave with you. They are solid, rock solid, not negotiable. These are the timings of the business. And when you start to trade the method, you will see how often they come in right at 3:15 and 3:30 and throw railroad tracks. You're going to see how at 9:30 at the equities open, they'll spike the low. Of course, there's variations on these times, but the session times are not negotiable. These are when the guys come on, and these are when you can expect the moves. So now, understanding that there is in fact a timing element is going to change the way you come to the screen and when you view the screen. There are going to be some days when they make the moves early and you miss it, yes. But if you think about what happened Monday night where they made a double top M and then they hit it again one more time at London Open, that London Open came in between 2 and 3 o'clock. There's your entry. You don't have to sit there and watch the whole thing, all Asian session and London session. I'm telling you, I'm going to narrow it down for you for a 3 or 4 hour window of opportunity for London and a 2 to 3 hour opportunity for US. Okay? Does everybody have the notes on this drawing? I'm going to pull it. Okay, look, I don't know what time zones you live in. You guys are from all over the world. I could never figure it out. Every time I've given you is the time right now for New York minus wherever you're from, or add from wherever you're from, okay? Okay, let me find the slides. I know they're here somewhere. Let's see. All right, I don't know what's going on. Let's see. Here we go. Okay, so now you understand what I'm talking about, okay? Let's look at things a little differently now. Now here's your accumulation phase. Okay? Here's your W formation with the second leg coming in as a hammer at 3:45 in the morning. Do you see that? Okay, I've circled it for you. You see it? Here is your railroad tracks to the high. Guess what time this structure was built? Between 9 and 10. The reversal comes in to end the day off of the high for them to go into consolidation and trap the traders long, holding long overnight. That structure comes in after the move is made overnight, right around the equities open, and ends the day back in consolidation. Okay? Double railroad tracks, when the high is held and not broken. See how the high of the day holds? And they keep hitting it? That high of the day holding, but when you don't understand what you're doing, you're thinking this, right? You're thinking up here. You're thinking the AB move, when the market comes to rest, buy, the CD extension, the lightning bolt. That's what all the retail traders think. But when the high fails to be broken for 30 to 90 minutes, up to 2 hours, when the high is not broken, it's safe to go the other way, keeping in mind the timing element that I've just added. Notice down here on the W how they set the low at Asia, spiked right past it to pick up the stops and pendings, and then just missed it the third time around. The near miss on the third time validates and confirms, especially at 3:30 in the morning, that you got the right directional bias. This is, in fact, the exact mirror image of what happened on the pound last Monday night, Sunday going into Monday. They hit it again, they hit it again, but don't miss, don't take it out. When you see the LOD hold, the low of the day holds, you look to go the opposite way. They spike the low, lower than here. That move gets anybody that went long right in here. It takes them out. Their stops are in here, right? That spike to the low hits those stops. When they trigger the stops, they've now lined their pocket. Now, there's some amount of people that went long in here. Again, after that spike to the low, right? This second pass ensures that they take all those people out too. And also ensures that the people that were thinking this got jammed up as well. This behavior at the W and at the M plays out over and over again in every pair, every day, variations on the theme. So your job is to look for an entry near the low of the day, long. Look for an entry short near the high of the day. If you understand that, you'll have success in the business. Okay? See the false move in here they got? Look. That's where the count saves you and your timing element saves you. This was 7:67 in the morning. This came in at session changeover. Chasing in the middle of the run, not understanding the timing element, keeps you from getting jammed up. The timing element is very, very, very important. The pattern, the timing, and the count. That's the order of importance that things are. Okay, so now you see it a little different. Okay, variations on the theme. How do they change it? What do they do? Changing the session in which the moves come will keep you confused. Changing the severity of the stop hunts. Okay, you get an extended 100-point stop hunt. Stop hunts, by the way, are typically 25 to 50 pips, and I'll cover that in detail coming up. If they change the severity of something, because traders are stubborn and won't let go of their positions, they'll make an extended stop hunt. They'll do something that looks like this. They'll come in, pull back, go up here like this, hang around. Traders aren't letting go of their positions. They'll hit it again and make the same structure and then reverse. Okay? They'll make a 75, 80, 100 pip stop hunt to trigger the traders to get them to go the other way. It kind of works like this. We're going to show you long. As a retail trader, I want you to take a long. I'm a market maker. I need you to take a long because I need some of my money back. So I break in 3 bursts coming out of the box, and I show you long. The traders don't bite. They don't commit. Well, I need you to commit. You don't believe me it's long? I'll hit it again and show you a long, buddy. You see it go up again, you feel as if you missed the move. So now you're like, damn it, it is going long. I get on. Traders commit their funds. I go, ha! Got you long. I was just kidding. Sorry about your luck. And I pull it down now the other way. The example of that, again, is the most recent chart, is Monday's 3 hits to the high. The third pass towards the high ensures that the retailers were long. But when that high fails to break, it is the signal for our group to take it the other way. Don't be fooled by the market maker's aggressive moves or the extended stop hunts to fall for his crap. Your job is to take a long near the locked low of the day and a short near at the locked high of the day. And I'll show you how to pick those points on the chart. The other trick that he does, he conceals the move behind the news announcements. You know that at 8:30 when non-farm comes out, that there's nothing different in Europe than there was at 8:25. He uses the news as the triggers to complete his patterns. That's why the news doesn't match the market behavior. And then you get these talking heads making up some crap that, oh, the Eurozone didn't bite for the bad news about the Euro. They took the Euro up today. That has nothing to do with it. It has to do with where they are in the market cycle and how the contracts are built up. If they take the market long or Euro USD long on negative Euro news? That makes no sense. But they might have formed a W yesterday and be at level 2 in the cycle, and they need to stop hunt low, rise the price. So that's why that behavior is seen. Nothing else. It has to do with their secret targets, their secret price objectives. Not, oh man, I don't understand, Euro went up today, the news was negative. They say traders reacted positively. No, market makers faked everybody out with negative Euro news and rose the price. That's what they did. They conceal the cycle and complete the pattern behind the news announcements. You think they don't know that non-farm's coming out? First Friday of every month. They probably licked their chops waiting for that damn day to come out. They also blame geopolitical events. Nuclear reactor meltdown spiked the yen. I know they spiked the yen and got a lot of people excited, and it rose immediately after the spike. They did a stop hunt low, trapped the trader, showed momentum. People thought the bottom would fall out, and they trapped them 400, 500, 600 pips in the hole. And I know people traded that without a stop and got jacked up because I got emails. The news and the politics of the world are secrets used to complete their private cycle and their pattern I've illustrated for you, nothing more. Don't be a victim of the market maker anymore. It's over. Okay? All right, here we go. Forex trading times, you can actually write them down. I'll go over them, then I'll be quiet for a minute. 5 p.m., high-low is reset. The market maker spread is set immediately at the open. 5:15, 5:30, right in that time, starts his business. The Asian session, 8:30 to 3 a.m. I left the gap time off of there from 5 to 8, dead gap. Okay? I'm going to throw it in there right now because then I'll never remember to put it on there. You guys keep writing. Let's see. 5 p.m. to 8 p.m. is dead gap. That's when a lot of traders try to scalp and all that stuff I talked about, all right? See, it spaces out. I don't know what the hell I'm doing here. All right, there you go. A little better. I need my wife up here to do this for me. Okay. Save it for good measure and blow it back up. Okay, 5 p.m. to 8, dead gap. Asian session, 8:30 to 3 a.m., gap time 3 to 3:30. London session, 3:30 to 9, gap time 9 to 9:30. New York session, 9:30 to 5. And I can tell you, as always, grab my pen. The New York session dies down between 12 and 1 o'clock in the afternoon. Okay, 1300. 12 to 1300, 1 p.m. Okay? No, I did put it. End of day gap, 5 to 8:30. I put it at the bottom. I don't know what the hell I'm doing. I'll erase this one now. Just kidding. All right, I'll be quiet for a minute. Write these times down, man. Every other time you've ever seen is pure crap. These are the times. That's it, period. Okay, hey, a very good question came up. It says, does the 8:30 to 8:45 p.m. candle, which is the Asian session open, have any significance? It's a very good question. It's not consistent enough for you to make a profit because the moves don't usually follow through in Asia. Because most of the time, Asia is used as the continuation, accumulation part of the cycle. Excuse me. But it is, in fact, the session open. You'll see hammers and stuff like that issued around there. But most of the time, that falls into setting the accumulation channel or the market maker spread. So you're not going to get the follow-through. I know Dick Schmidt likes to trade during those times, and he takes a small float out of the market during the Asian hours. Okay, well, I don't understand some of the questions. Are the timings plus or minus? Plus or minus what? Allen, confirm adjustment for winter in London Open. Okay. We go move the clock back an hour. So during the Asian and London session, move everything back 1 hour for winter, which is coming up when we move the clock October-ish. Here's the catch today. Got to be careful. Yes, Craig, I'll read that in a second. You got to be careful about this is, since it's Europe, London Open, that side of the world, if they haven't moved their clock yet and you have, then you have the adjusted time. But they might still move around 3 o'clock an hour later. When all parts of the world are honoring daylight savings time, when everyone's in line. So check. There's websites that talk about that stuff. Okay, yes, Craig, at the beginning of the session, you're looking for the false move. What happens is he'll end the session with an aggressive move, and then the new guy comes on, and they'll make a continuation of that move, false move. Let's say Asia was up, right? So Asia paints the first leg high. He pulls back, end the session, false move. London comes on, or trap move. London comes on. He makes the second leg of the W or M by pushing it up back towards the high. He might even spike the high and take it out to pick up the contracts. Then he'll reverse off of that number, false move session beginning, run his trend 6 to 8 hours into US. And then he might make the first leg at 8:30 or 8 o'clock, go into consolidation, spike it again at 9:30, issue a hammer and reverse when the new guy comes on. False moves are made at the beginning and end of the session intraday to trap the traders into swap and to jam them up for tomorrow. The same pattern also repeats throughout the course of the week. You'll have the same consolidation, tight range Sunday going into Monday, false move week beginning down, a multi-session M or W, which is they set the level on Monday, repeat the level on Tuesday, in line with the stop hunt. Okay, and then they'll make the unidirectional swing week ending a minimum of 3 days. That's where the guys that are catching the swing trades are coming in. The potential for a swing trade is 300 to 600 pips captured at the peak formation high of the week, peak formation low of the week. If you catch one of those points, you got about a 300 to 600 pip spread that you can grab for yourself. And I have people doing that consistently. I don't do it. The reason why is this. If you haven't noticed, I'm a little high strung. If I wanted to stay married, I had to get the laptop off of my night table with my positions on. So since I can't look at it without waking my wife up and pissing her off, I needed to just be flat at the end of the day, the end of my trading day. Okay? So that's why I just take more contracts, grab my float, and I'm done. And at the end of the day, everything's off the board. I'm square, flat, whatever you want to call it, and that's how I trade it. All right, does everybody have this written down? It really is an important slide. Okay, cool. All right, it's driving me crazy that I messed up the slide. I can't help it. Part of my personality. Let me erase the bottom of this. Let me erase this one right here because it was right. I didn't know that was on there. Okay, cool. Back in business. Okay, now, the timing is the second most important element of the business, right? I told you that. So you have to time map your dealer. Most important element of the business, the pattern. Market maker behavior, identifying that. Identifying his behavior at the right timing keys is solid gold. So now, the new indicators that we gave you, if you have Craig set, I'm sure he'll help you. Sorry, Craig, I put that on you. The new indicators have to match the time of the dealer you're using. If you don't have a dealer, I'd like you to contact Compass and let them put you into a good dealer. If you have a dealer, if you're offshore, if you want to trade, that's fine. But you have to identify the formations at the proper times or else they're garbage. You'll see M's and W's all day. If you don't understand the behavior at the gap times and the changeovers, you're not doing it right. Don't get confused with the time ribbon on the bottom of your broker's platform. That's their server time and where their server's located. Some of it's GMT plus 2, GMT plus 5, New York plus 6. You got to figure that out. I'm pretty sure Gary posted in the forum a little script that you put on your chart and it pings the server and gives you times all around the world. The broker server your time, your trading zone, all that stuff. It's pretty cool. If you don't have it, go to the forum and get it. Put it on your chart, write down the times, bounce it off your broker server, ping his server and get the times, and make the adjustments accordingly. The way to make the adjustments is to go into the work time ribbon. I should have wrote some slides on that. I'm sorry. I will for next class. Go into the work time ribbon and make the appropriate adjustments. Okay? To match the timings, you should have your shadow boxes, your stop hunt zones, all need to come in at the appropriate times to show you where the possibility of the reversal and the stop hunts will occur. If you loaded the indicators today with Zen, if you haven't, it's okay. We'll look at the charts in a couple days. The charts are irrelevant right now. You got to grasp this concept and change your way of thinking. The chart is not important right now. We will look at the chart. You got to wrap your brain around the stuff I'm telling you first. And that's going to be a couple of days before we look at charts. I said this before, I say it for the last time. All other time references are garbage and should not be followed, other than the times I've given you. That's it. That's your new times. Okay, a little more about the Brinks trade. The two most telling candles come in from 3:30 to 3:45 at the London session opener. 9:30 to 9:45, the U.S. opener sets up the Brinks trade. Make a note. Okay, I lost the chat window on you guys. Sorry. So I can't see if you're asking me anything. There it is. Give me a second. Sorry, guys. Okay. Get it off of there. All right. Here's what I'm talking about. Let me grab my little pen and let's talk about this. Kind of crazy. Consolidation. 1, 2, 3 to the low. 3 bursts. Variations on the burst. I'll illustrate a few. Okay, some people are saying I went too fast on that previous slide. I'll go back one for a second. You guys should make a note. Sorry. Let me back up a second and leave that for a minute, too. All right, write it down. I'll take a second. I'll have a sip of Diet Coke. Okay. Coming right out of the box, you have 3 vector candles. The vector candles are an aggressive move. It's an engineering term or a, I don't know, Zaim came up with this term because he was very technical and he needed something to make him feel better. So we came up with this. Market makers extend the initial low of the day in 3 pushes, right? This is the initial low of the day, correct? They extend that low in 1 burst, 2 bursts, the 3rd burst. The 3rd burst happens to hit our pre-measured 25 to 50 pip stop hunt zone. The stop hunts are made in 25 to 50 pip increments because they know where people trade and put their stops. This box is 25 to 50 pips. The shadow box comes in between 3 and 4 o'clock because there's variations on the theme. Just so happened they issue a hammer right in the middle of the shadow box. You got 3 swipes at the low, 25 to 50 pips stop hunt zone. They issue a hammer in the shadow, which is the session changeover. Understand this candle was solid red at one time, right? You guys know this. Solid red pushing down. What does that do? Induces traders to go short. They then shift the zone away from the lower level shorts over here. But look what they did. They're dirty. They opened, they turned this red to push down one more time. You know what that did? They opened the spread around here too. When they get down here, they open the spread. Anybody that was already long in here has their stop. Where do textbooks tell you to put your stop? 3 to 5 pips below the candle I got in at, Steve. That is an absolute sucker's bet. You will lose your money every time. The stop loss goes below the low and above the high of the day. I will discuss it exactly where it goes. Market maker's job is to take your money and hit the stops, right? I told you this already. They absolutely ensure that they're going to get all the weak long holders spiked out right there. Anybody that's traded down to here by opening the spread at the low. The two gray boxes are, the shadow box is the gap time of the session. The gap time going into the open. The big gray boxes are the stop hunt zones. Okay? If you took the breakout here, okay, you remember the breakout systems? You bracket, break plus a close, you entered here. You saw very little profit on the spike, and then they pulled back and they jammed you up. If you didn't have the stomach to take the break here, you did not have a successful trade today. Or if you lifted your stop on the short, you were dragged backwards all freaking day. Anytime market makers hit a level 3 times and don't break it, the reversal is imminent. They will reverse. Look, hit, don't break it. Hit, don't break it. Hit, don't break it. There's your entry. If you entered here, you're okay. Why? You're okay because your stop goes above the high of the day. The high of the day will not be broken on these formations because there is some amount of money trapped above that price point. If they come back and break the level, it releases those traders' money back into their account. They're in the job of freezing the money in open float so they can take advantage of it and grab it up for themselves. Every chart that I show is 15 minutes unless I specify otherwise. Okay, so here's your opportunity for the trades. You had stop hunt low rise, easily identified, brings trade in the shadow, 25 to 50 pips, 3 pushes out of the box. 2 pushes, consolidate, 1 more push to pick up the orders. You had a straight rise. If you grab the entry in here, anywhere in here after the hammer's issued in the shadow, you had a straight rise of profit. You were in profit in the first 15 minutes of the trade depending on where you grabbed it. Maybe in the first 30 minutes of the trade. You then went negative, which used to scare you out of the business. When that went negative on you, 4, 5, 6, 7 pips, what'd you do? You're like, oh crap, they're going to get me. I'm going the wrong way. Any trade that you ever take with this method remains valid until your perceived low of the day or high of the day is breached. Let me say that again. It's important. Any trades you take with my rules and my method remains in play or valid until the low of the day, where you should be entering long, the high of the day, where you should be entering short, is breached. What do I mean? Okay, let me draw. High of the day is formed right here. You took a short right off it. You got jacked up. You're excited. Okay, no problem. The better trade is just inside the shadow box short. That's all right, though. They hit it again. You're short right here. Your trade is negative. Your stop loss is above the range. You're out of the range. You're out of the grasp of the market maker. Think for a minute. He is not going to move a $4 trillion market to get Robert. Or Ted. I don't know if Ted's in here. He's not going to move the entire market back to get outside the range to pick up your measly 1-lot contract. No offense to your lot size. Understand? If he moves a $4 trillion market back up, he releases $500 million in volume to pick up your order. He has 2 hands. In one hand, he has $500 million grabbed up. Right? He'll look at, right? He'll move to a level and analyze. He pulls away and he goes into consolidation off the high, right? If there is $700 million up there, he nets $200 million. He'll break the high. He lets go of the 500 and grabs the 7. He's a greedy bastard. If you understand that, he is not going to move the market unless it's financially advantageous for him to get your stop order. Some of you are writing that sometimes you feel like he goes after you deliberately. No. The reason why that you feel like that is because you've read all the same books that all the other guys, 90% of the traders, have read. And you put your stop where 90% of the traders put it. So what's going on here is you get in and you go, oh, my stop's right here. This looks good. It's a good trade today. Market maker comes back, spikes the high, and takes your stop out. And you're like, damn it, I swear to God, he's personal against me. Then it drops like you thought anyway, right? He's going after me personally. No. You've all had the access to the information that everyone else has had. It's all the same general knowledge. It's all bullshit. So when everyone gets stopped out at that price point, it's because the technicals that you saw that he deliberately showed you on the chart validated what you read in the book. So you took that trade based on that garbage, and he laughed to himself as he hit your stops, all 100 million of you. Understand? That's why when you took those trades and they didn't validate and you felt like he was personally attacking your stop loss, he was not. He is not going to move a market to a price point to get Mac or to get Michael. He's not going to do that. But if it's financially advantageous for him, he'll make the second pass or the third pass. This costs money to move the market. I heard that it takes 10,000 lots to move the market. A pip. I didn't hear it. I was taught that. Think about that a minute. If you have to move the market all the way back up here, it costs money. If it costs money, he's not going to do it unless he can make some in the process. All right, I want you to notice some crazy stuff built into this structure towards the high, okay? I want you to see a 1, 2, 3 back to the high in there. Do you see that? 1, 2, 3 back to the high. Why? To induce you to chase it long. I want you to notice they rise here, and each subsequent pass fails to take out the previous high because there's trap volume here, there's trap volume here, there's trap volume here. There's stop orders all aggregated in here and in here. His job is to hit the stops, don't release the volume, hit the stops, don't release the volume, sorry about your luck, just kidding, and drop price 100 pips off the high to end the day back in consolidation. Boom, right here, end the day back in consolidation. And just if you weren't sure, he has to end the day on a hammer to trap anybody that was chasing it short last minute, snatch that away from them, and end the day trapped, carry you into the next day. Do you see what I'm drawing, what I've been illustrating for you? It's in there. Releasing the volume means that if there's a certain amount of traders that they already trapped, by going back to that level, it allows people to click their mouse and get out. Think about yourself in your own trading. How many times have you been jammed up in something instead if it goes back to +1, I'm getting out. If it goes back to -5, I'm getting out. When you come back near the second pass, you will be minus some number plus the spread. -7, -5, +2, +1. I don't know. It depends on where you got in. So what he's doing, if he goes back and breaks that level, he's allowing those traders that were jammed up a chance to close their account out with a small scratch or a small, loss or gain in the trade. His job is to not allow that behavior, so he fails to take out the high. Okay? All right, I hope you guys are good. Let's see where we're at. Next slide. Okay, it's 8:30. We'll do this slide and we'll break for 30 minutes is a good dinner time. We'll try 30 minutes tonight. If it's too long, we'll shorten. If it's too short, we'll go an extra 5, whatever. I'm going to grab a little something to eat, and I'm going to get some more Diet Coke. If I'm not jacked up enough for you guys, I'm sorry. Some of you made comments. I feel fine, man. So if you think I'm too calm tonight, I'll be more excited tomorrow. Okay, look. Very important to understand. Market makers have limitations. They are limited what they can physically do to the market. If you think about this for a minute, they're controlling the value of imports and exports. You buy Toyotas and you switch your dollars to yens. They're controlling that. They cannot just wake up one day and drop in 1 million pips and devalue the dollar or devalue the yen. They cannot do that. They have restrictions placed on them by the IMF and the World Bank to try to keep this world afloat. That is why the average daily range tool, told you I'd get back to it, Mac, is a useful tool and can only move most pairs about 200 pips a day to 600 pips a week. And if you notice something on some of these charts, they will open the week at a price point, go berserk, and come all the way back and close the week around the same number. They do not, contrary to popular belief, have unlimited equity. They got to get their money back. That's where the retrace against the trend comes in. They lend it out, they lend it out, they lend it out. They got to get it back. They are limited by weekly net change allowances. They have a couple of times during the month where they can run rampant, but they got to get it back under control. Think, use your head. If they could do that, they would destroy the world economy, and things are bad enough without doing this to people. They have some limitations. Understanding the limitations gives you an edge. Understanding that they don't have unlimited movable pips gives you an edge. Okay? All right, let's take... It's 8:31. Let's go to 9 o'clock, and we'll pick it back up from there. Hope you guys are doing okay. We're going to go to about 10:30 tonight, I think, and then we'll be good. All right, let me find my little clock somewhere. I'll pop it up there. Go ahead and grab a break. I ain't going to say anything now that it's break time. I won't do that to anybody. All right, let's see. Clear. 7 minutes ain't going to work. I saw a couple questions. Craig had 2 good questions. Let me cover those real quick because they are time appropriate. They're in the right segment. Steve, you said there's 3 important things: the patterns, the timings, and what? The answer is the levels. Okay, most important element of the system: the pattern, identifying the patterns from the market maker behavior, the timings of those patterns, and counting the levels. The levels are not going to come to you overnight. They're difficult. There's people that have been around me for a year still struggling with that. It is not an absolute necessity to be successful with this method. But understanding the levels will let you know when the reversal's coming, when to exit your swing trades, and so forth. Okay, weekly net change allowance was another question that came up. Let's say they open at a price point. They are given, just to make it easy, 1,000 pip movement weekly net change. So from the open price point, in the 3 to 4 day swing range, they cannot exceed 1,000 pips on the close on Friday. So if they rise price 1,000 pips or 1,100 pips, they have to come back below the 1,000 pip marker that's given to them before the close on Friday to keep currencies from being devalued or whatever. There's seasonal targets, quarterly. There's daily and weekly ranges that they're given. Understand they're making money, but at the same time they have to be cognizant or aware of what's going on in the world economy and the world markets. They cannot destroy things. So they're given a price point on Monday or Sunday night at open, and they have a weekly net change of 500. They run at 600-700 pips. You can expect the reversal back in to underneath the 500 limit by Friday close. Hence, false trap move on Friday to end the week. Okay? And then the cycle starts over. All right, those are some good questions. I think some of the other stuff wasn't pertinent to right now. Let me look a minute. Nice to have you, Adam. Glad to hear you're doing so well. Shahid from Toronto, I think you left. You'll be back. All right, Ronald, nice to see all you guys. All right, let's get going again. Everybody settled in from their break? Got something to eat? Okay, listen, the reason for the break is I want you to think. I don't want to just sit here and I want to throw a fire hose at you with tons and tons of information, and you sit here just mesmerized by what the hell did this guy just say. That's not the point. I talked to you about some stuff, some concepts. Think about it on your dinner break. Resonate on it a little bit. Tonight I'm going to give you some homework assignments to think about more stuff. We're going to go about 4 hours of time. 10:30, 10, I don't know. We'll figure it out wherever I am on the slides. The point of that is that I don't want to just sit here and just keep stuffing stuff down your throat. I want you to think about it overnight. And when I've taught live, I noticed that people have about had enough in about 4 hours. I'm not so full of myself that I don't realize you get tired and that I think I just have so much great stuff to say. I understand that. So 4 hours is the marker to where you've had enough of sitting in the chair. Seems to be when I'm teaching live, people start slouching their chairs, putting their heads on their desk. Gloria fell asleep on me one time. 4 hours in. So I realized 4 hours is a good marker. Take a break about halfway through. Get up, eat something, go smoke one. Subio, did you quit, by the way? I've been trying to quit Diet Coke. I almost made it, and I fell back into it. I'll get it, man. Anyway, the point is that I want you to get this. Me rushing through it to get all the information to you is not the point. The point is it's a process. It takes some time. I asked if you quit smoking, Subio. I know you were trying. I've been trying to quit Diet Coke. Anyway, that's the point of the break, okay? Appreciate it. I want you guys to really conceptualize and understand this. It's not going to be part of you until you conceptualize and it becomes your own. And that's the point of going slow and making sure everybody gets it, okay? All right, back to the slides. Market maker moves, all right? We understand all the things we talked about, the pattern, the behaviors, what they do. So what can they do? What can they really do to you? They are limited by weekly net change and allowances. They're also limited to, they can hit your stops up or down. They reverse off of the high or low and create an intraday trend change, which happens a lot. They can do a straightaway, straight rise or drop, which is the finishing move on the margin levels of the other traders. I'll illustrate that for you, don't worry. Timings and test your patience, right? What do I mean by that? You get in something, you lift your stop, you're down in negative float. They go into consolidation, change shifts, the Asian guy comes on, you're still sitting there. What happens after a day, day and a half of doing that? Your nerves are shot. Your patience have been tested to the max. You're drinking Red Bull, kicking the dog, cursing under your breath, and you finally click out of the trade because you can't take it anymore. Understanding that all they have is timings and stop hunts and trap moves kind of removes the curtains from Oz. You understand what's going on. That's all they got. They're limited. The problem is that the other technicals set you up for failure and keep you chasing the wrong things. Like I said earlier, it ends today. Okay, this is one of my favorite charts. This is 2 days back to back. Go look at it. It's in the pound. It's in March 15th. Stop hunt high, spike to the high, drop. W formation to end the day, back in consolidation. The next night, stop hunt low. There's your three pushes, your vector. Right? Come right out, rise price, right back. Here's your weekly net change, Craig. 2 days, no change. The price closed exactly where it opened. It's kind of funny. This is they got to be kidding, right? They come out, hit the stops high, three pushes, drop. W formation back into consolidation. The next night, they exceed the trap level here by making a stop hunt to trigger the traders, induce the pendings, and then snatch the market away and run it back. right back to the same price point they were at yesterday.